Hey everyone, Chris Urso here. We're with part two now where we get into our portfolio KPIs. We're going to take you through our acquisition activity, refinancing activity, and then our operational performance for Q4 2025.
Okay, so a couple updates this quarter. The first and one of the larger updates is our newest acquisition. So in Q4, we closed on the Towns at Pryor in Wilmington, North Carolina. This is a 117 unit townhome community with direct entry units, private yards, and really high cathedral ceilings. Really nice product. It was an off market opportunity from an owner whose primary focus is really office and industrial, which left a pretty large operational opportunity on the table. So this was limited marketing, minimal online presence, and rents that had largely been untouched or minimally touched for years, which is exactly the profile we like. We moved really quickly on this. This is one where we got a rent roll in on a Friday, and I was on site that following Monday, and the PSA was signed that week, North Carolina standard form. So we closed this in under 45 days from learning about the opportunity. So look, right now we're just about 2-3 months into execution, and we're already seeing really strong traction. Lease trade outs are averaging roughly 22%, over $200. And resident retention has been running north of 60%, right around 65%. And on the renewal side, we're getting $100 to $200 renewal increases as well. So these were $1,200 rents with clear upside towards market levels. On the financing side, we partnered with a regional North Carolina bank and secured a pretty great structure, priced at 185 over SOFR, with a lot of prepayment flexibility. So we have a lot of optionality as we execute the business plan. It's 3-year interest only period. So it gives us time to really drive NOI. The nice thing about this loan is the structure we use, there's a construction holdback. So we're not required to draw the funds, and we only pay interest as we draw funds from the construction holdback. It's a great setup for these value add deals because it allows us to improve the product methodically as units are turning, over the first couple of years of the whole period without having to pay interest or having to pay pref on idle dollars that aren't being put to immediate use. Since closing, we've already completed several visible upgrades. We added a main entry fountain. We have new patio and grill amenities in place. And we also expanded the fenced-in patios for about 18 homes, which has been a big positive for pet owners. They have a lot more space now for dogs and cats and what have you to run around. So we're moving through the interior renovation side and rolling units into our deluxe and platinum finish levels. And both those improved finish levels have been received really positively by the market. Overall, it's exactly the type of acquisition we've been targeting: strong location, durable townhome product, and a significant rent delta to market. So early indicators are lining up really well with underwriting, and we're really excited about where this asset is heading through 2026. Large portfolio update is we had a refinance here in Q4 right at the beginning of the quarter. So we refinanced out of our construction financing at Farmhouse Apartments. Farmhouse Apartments is 288 units in Murfreesboro, Tennessee, about 45 minutes outside of Nashville in the Nashville MSA. So our new loan is through Arbor. It's Fannie Mae product, 7-year term, 5 years interest only. Really great rate, sub 5%. We're at 4.87, I believe. We had a significant return of capital on the refinance, just north of $9.5 million. So we're in a really great place from a financing standpoint. Farmhouse Apartments is an OZ development, so this is at minimum a 10-year hold. So we have a nice runway ahead of us to continue pushing on renewals and operating this asset.
So our KPIs we're going to jump into now for the fourth quarter. We're going to start out with a little bit of a portfolio overview. So right now, URS Capital and URS Properties have 15 properties in the portfolio, just under 2,900 units across 5 states. As Chris referenced earlier, we had one closing in the fourth quarter, Towns at Pryor, and we actually just had a closing in the first quarter of 26, which isn't on this as of yet. It'll be on the next update, and we have one more closing coming up as well in a couple weeks here. So we're going to be adding close to 600 units to the portfolio across 2 acquisitions in the first quarter as well. So that'll bring us up to 17 properties. So in Q4 2025, our traffic and occupancy numbers, really main thing to look at here is our occupancy quarter over quarter. You could see we closed out the fourth quarter. Again, before I even get into that, a quick refresher on how we've broken down the KPIs. So we have three baskets. Essentially, stabilized properties are assets that we've owned for over a year. Are recently acquired, or those assets that have been acquired within the last year that are going through some sort of reposition or operational plan. And then we have our active development and lease ups, which is 2 assets. So for the stabilized assets, it's about 1,673 units across 7 properties. We generated just under 3,000 leads, so 2,880 in leads, which resulted in 360 tours and 151 net leases. So we closed out fourth quarter at 95.2% occupancy on the stabilized portfolio, down just a touch, about 1 percentage point from the close of Q3. And we're really proud of that. We put a big initiative in place, which you've seen in prior updates. This year, we implemented Rentana, which is our revenue management platform, AI-driven, which really compiles all of our daily activity at our sites when it comes to leasing and helps manage expirations, traffic, pricing, renewals, et cetera, and our exposure. So we really put a big effort, I'd say starting back in June even, to get ahead of our expirations in November, December, and January to help offset any sort of significant dip in occupancy that might come from slowing traffic in the fourth quarter. So really happy with the results on the occupancy side. For our recently acquired assets, which is 6 properties, 717 units, we generated 1,253 leads, which translated to 160 tours and 59 net leases. That you could see we closed out at 95.3% occupancy on those recently acquired assets. That's up 2 percentage points from the prior quarter. So we're working our operational and reposition plans, implementation of our management policies, procedures, et cetera. It's good to see that, incremental move on occupancy. So you could see between the two, that's 13 properties. We closed out about 95.2% on occupancy. Our developments and lease ups, which are the Ash and Cypress Point. So this is focused just on the Ash, which is in active lease up as we speak. That's 319 units in Asheville. Cypress Point, which is 180 units, is not open for leasing yet. That'll be opening up in the next couple of months. So these numbers are based on just the Ash. We had 548 leads, 73 tours, and 30 leases in the fourth quarter, which in Asheville, with the weather, holidays, et cetera, we're really happy with that movement there. We saw a pretty meaningful move on occupancy quarter over quarter, which is the goal in a lease up. We don't rest until that number's at 95, but, really good movement, 12 percentage point increase quarter over quarter on occupancies. And that's during one of the slowest leasing periods throughout the course of the year. So as you can see here on this slide, there's a lot going on, so probably a little hard for you to see, but it breaks out the quarter over quarter occupancy across each one of our assets in the portfolio. And you could see here, blue is fourth quarter and gray is third quarter. So, Belmont Heights, I'm not going to go through each and every one, but pretty consistent, 97 in the third quarter, 95 in the fourth quarter. Crescent Place, 97, 94. Latitude South Portland, 93 to 94 and a half, 96 and a half. Sorry, it's even hard for me to see. But Rock Hill, strong occupancy. Views at River Bend, definitely still a little bit lighter on occupancy than we'd like, which we're working through, battling some supply. One of 2 new deals that were in lease up just recently stabilized there in that Beaufort market, which is a smaller market, so you're going to see that impact. Cobalt Row is our student housing property, 96% occupied. And then you have our 3-pack in Asheville, which vary from 92% to 100% to 98%. Flats at Leland closed out 94.4%. That's in Wilmington, Palms at Edgewater, in Somerville. This deal was acquired in April. So we bought it, just a little backstory there on this one, bought it in April of 2025. From the original developer, it was kind of bouncing around 88, 89% and hadn't been fully stabilized as of yet. And we knew going in, based on our diligence, that we were going to have to reposition and re-tenant a lot of the property. There was, the tenant screening policies were not to our standards. So we had a tremendous amount of non-renewals, evictions, and move-outs in our first 6 months. So you could see a big move there from 90% to 95% here in the fourth quarter. So yeah, 95.5%, sorry. And then as referenced earlier, the ash there going from 22 to 34.8% occupancy.
Q4 2025 lease trade outs. So I think this is a really interesting slide because it tells a story of what's going on as an operator in the Southeast right now. So our average increase, or in this case decrease, on new leases is negative for the quarter, negative 4.1%, as you can see here in the chart. So when someone moves out, the next resident is coming in roughly 4% below the prior rent, which is significant. And on top of that negative 4%, you also have marketing costs, downtime, turn costs, and everything else that comes with a vacancy. So move outs are very expensive right now. But if you look at the chart on the renewal side, however, we're seeing a average of positive 3% increase. And again, on the renewals, there's virtually no cost associated with the renewal. So what this chart doesn't show is our resident retention from the portfolio is right around 65% for Q4. So when you blend that together, overall growth is still slightly positive, just barely, ranging in that 0 to 1% range. And that makes pricing very sensitive right now. In order to grow top line revenue, you do have to push on the renewal side, but it's something we're monitoring very closely because if you push too far and lose a resident to a competitor, it becomes very costly to replace that resident. So renewal strategy is a key focus for our team right now. It was a key focus in Q4, and it's going to remain a key focus for all of 2026, managing that renewal process very closely. Q4 2025 move-ins. This is a nice chart that just shows total move-ins across the portfolio. As you can see, big decline at Cobalt Row, which makes sense. Q3 was the start of the school year and peak turn season, so that's expected. Across the rest of the portfolio, move-ins were generally lower in Q4 compared to Q3, which is really by design. We try to structure our leases so that they don't expire during the slower winter leasing months, which helps us avoid too much exposure from November through January. The Ash had 39 move-ins for the quarter, which is great for Q4. We're making really strong progress there. We actually reached about 90% occupancy on the available units, and we expect to receive final and full CO in Q1 2026. So it's great to see steady leasing momentum continuing there through the winter. Q4 2025 bad debt. Happy to report that bad debt across the portfolio is under 1.5%. We take a lot of pride in our screening process and have strong standards and procedures in place to ensure timely rent payment, and also just attracting quality residents who are able to pay on time and consistently. When you look at the stabilized portion of the portfolio, we're actually closer to 1%, which is a tremendous job by both the asset management team and property management teams. They work really hard on a daily, weekly, monthly basis to keep bad debt low. So it's a great job to the team there. Our recently acquired assets are running a little bit higher, closer to 2%, but that's trending down quarter over quarter. And really that's expected. We're often acquiring deals with some sort of broken management or some level of distress. Not every deal, but a lot of what we've been buying lately. So higher bad debt early on is something that we plan for and underwrite into the business plan in the early months of the hold period while we reposition the asset. This slide just shows the bad debt write-off. So really this breaks down bad debt by property. Creekside Arden is a smaller deal. It's part of a 3-property portfolio in Asheville. We did have 3 evictions there in Q4, but I don't expect that to be a trend, more of a one-off situation. Cobalt Row did see an increase in skips and evictions in Q4, tied to the end of the first semester. which that tends to be consistent. We saw that in 2024 as well. So not too much of a surprise from a seasonality standpoint. Palms, on the other hand, showed pretty good improvement in collections towards the back half of Q4. And we expect that positive trend to continue through Q1 as we continue to reposition the resident demographic, reposition the asset from prior ownership. We'll reach our 1-year anniversary of Palms in May. So that property has seen quite the turnover. So we do expect bad debt to continue to trend down as we move through 2026.
So we're going to take a look at the fourth quarter NOI trends quarter over quarter. Again, looking at stabilized, recently acquired, and development. You could see fourth quarter NOI as a whole, and we're looking at this on a portfolio level. Many of our investors are invested in every single deal that we do. And I think, what we're trying to learn from and implement are best practices in sharing data with both our investors and the public from a transparency perspective. So looking at the portfolio of stabilized assets, you can see we had about 2.8% NOI growth quarter over quarter. So moved up to $5.86 million in Q4 from $5.698 million in Q3. Our recently acquired assets saw a big jump there, up almost 21%. And obviously, those are going to be some big moves from properties that are operationally challenged or had some much higher vacancy than normal when we acquire them, right? So that shows our business plan is working quarter over quarter in terms of stabilizing the assets and moving them, in line with market. And then obviously the Ash, we had a big move there, positive NOI, which is, a big positive when you're going through a lease up. So good progress across the board. You'll see as we drill down, some of this was, attributed to our student housing asset, given, turn season all happening at once in the third quarter. So, you see a little bit of a drop there due to a heavy expense load once a year, and then you'll see it move back upwards in Q4. So you could see here, much like, the other charts, the breakout of where the NOI growth came from. Belmont Heights saw a good movement, and that's suburban Charlotte, Belmont, North Carolina. Crescent Place, pretty much flat and in line. Latitude South Portland had a slight dip in NOI, not to be unexpected in, given Portland, Maine seasonality and, just the challenges of snow and cold, et cetera, tend to be a little bit less leasing traffic. But everything else, you could see pretty much in line quarter over quarter, with the biggest movers being Flats at Leland, Palms at Edgewater, which is great. Again, that was acquired back in April of 2025. So we're seeing those moves and incremental growth now come back. We kind of, on those deals, you'll take them over. They'll be here. They're going to come down. They typically come back up. They come back down again as you get through kind of your first 6 to 9 months. And then you start to see, that incremental upward trajectory as the business plan really takes shape. But Cobalt Row, you can see here as well, big mover, and Flats at Leland. That was a deal we bought in October of 2024 at 24% occupancy, highly distressed, completely repositioned the whole property. And about a year later, we were at 95%. Really proud of what the team accomplished there, turning kind of a blighted community into a really well-run, very clean, well-maintained community in the Leland submarket of Wilmington. So overall, kind of looking at the year over year. So for assets that we have the data behind, where we now have a comparison of 24 to 25 from a portfolio level, we saw NOI grow across these 7 assets on average 4.9%, which is going from about $18.8 million to $19.7 million. So almost $1 million of NOI growth comparing 25 to 24. So, very positive NOI growth. You have to work for it. This has been a very concerted effort over the last couple of years internally to shift our focus as the market shifted, right? And the market's been absorbing, again, 50-year highs in supply. Rent growth has been relatively non-existent outside of, mark-to-market opportunities where we bought like things like Creekside from long-term ownership where they're materially below market rents. Towns at Prior, very similar story. We've been very focused on NOI growth. We've been hammering that into our COO, obviously, has been, positioning that all the way down to our managers, from our COO to our regionals to our managers. It's focusing on NOI growth, right? How do we get incremental NOI growth quarter over quarter in an environment where there's no rent growth to be had? And that's really a function of focusing on driving occupancy, being diligent about collections, managing bad debt effectively, and managing your expenses as tight as we possibly can. It's really focusing on, the pennies, the nickels, and the dollars on the expense side day over day. We've seen reprieve on insurance, which has been fantastic. We've gone out with several renewals at this point that have either been flat to negative on the renewals, which is fantastic. We've been pounded with insurance cost increases since 23, 24. In 25, we started to see it settle, and we're getting positive feedback already in 2026. But just little things. Our COO from Urso Properties, Jennifer O'Brien's been a tremendous asset for us and resource. She came from a very large third-party property management firm based out of Charlotte, and she was with them for over 7 years, from about 1,200 units to 17,000 units when she left and made the move to Urso Properties. So she's bringing a kind of an institutional third-party mindset to Urso Properties, which only has 3,000 units relative to the portfolio that she's accustomed to running and company size that she's been accustomed to running. So she's been able to leverage vendor relationships, renegotiate contracts for us, just things like valet trash. So if you're not familiar with valet trash it's a third-party service that we provide to our residents where it's valet, exactly what it sounds like. They put a garbage can outside their unit every day, put their garbage in it, and the service comes around and collects it. So residents don't have to take their trash to the waste compactors or the trash bins. It's picked up for them. But we're able to charge our residents for that service. And Jennifer's been able to do a great job reducing our cost there by almost 20% per unit. And as you continue to grow, $5 or $10 a unit across 3,000 units adds up pretty quickly. And these are just the little things that we're focused on in an environment like this where, you're not getting any free rent growth. Many of you have heard me say this before on past interviews. You're giving away free rent, but you're not getting any free rent growth. So we have to really be disciplined on focusing on NOI. And Tom DeGilio, who came on, has now hit his 1-year anniversary as our head of asset management, has done a great job. Just his sole focus is our properties, the business plan, managing the teams, communicating on a daily, weekly, but structured weekly calls with every asset, doing deep financial reviews every month of each asset, navigating Rentana, our revenue management system. All of this has been a collective effort to produce these results and capture positive NOI growth. So as you can see here, this is the breakout of our NOI growth or loss year over year. Not every deal has been positive, as you can see. We've seen incremental growth across the board outside of Crescent Place, which is the one asset we bought in 2022. It's a 1970 vintage property. It's 232 units in Savannah, Georgia. It's great workforce product. It's 80% townhomes, 2 pools. We did a $6 million renovation on this property. It was fantastic. We crushed it. We bought it from a 25-year long-term owner. Rents were the lowest in the submarket at an average of $988. When we completed our reposition plan in 24 months, we had the rents up to over $1,500 on that property. Tremendous execution. What hurt us was obviously interest rates. We did it on bridge financing because it was a heavy renovation. Interest rates went up, a couple of 100% during that time. Insurance costs practically doubled, given the vintage and the location, the coastal location of the property. And then the market started to get massive amounts of supply delivered. So we are coming off a tremendous high on that property, and now it's a little bit of giving some of that upside back in the short term to maintain higher levels of occupancy on the property. We were able to refinance it. It's been just about 18 months ago, give or take. And that's one of the toughest properties, but it goes back to what I referenced in part one about the 70s vintage assets and what it takes to run them in today's environment. I think a lot of people underestimate that or are unaware. To maintain a really good, clean product to our standards, you have to constantly be reinvesting into the asset to maintain that occupancy. But you could see Latitude South Portland, Belmont, Exchange at Rock Hill has been a really good mover for us. Farmhouse Apartments, first full year of stabilization. Cobalt Row saw great, growth. We're coming off of, we've seen an average of 7 to 10% rent growth at Cobalt Row, our student housing property. I think we're at the point where we've hit the peak on rents there. From what we're seeing this year, it's going to be more in line with the standard 1 to 3%. But we've captured meaningful upside in rents since we bought that deal during COVID. So it's been a great asset, great earner for us. But again, all the effort that we've put forth and the investments that we've made, when a lot of people have been laying off in our space, shops similar to ours, maybe that haven't been around for 15, 16 years, but have been around for the last 5 years, 10 years, and I'm only seeing a significant run up. A lot of them have been playing massive amounts of defense because they went on a buying spree in 21 and 22. They have not been able to continue now to buy into this reset where we have been able to do that. And we've been able to make meaningful investments into our people, into technology, into operations to get us to this place. So I'm extremely proud of what our teams have been able to accomplish, to be able to look at these 7 assets year over year and see positive, NOI growth for the most part across the board. And for those investors, again, while we're not a fund, a lot of our investors invest, like I said earlier, in every deal that we do. So we know that every deal is not going to be a home run. There's going to be plenty of deals that have challenges. There's also going to be plenty where we're surprised to the upside, where we went in very conservatively and we're able to outperform on the front end of those deals. So in the fourth quarter, we invested on the existing assets side. We invested about $850,000 of CapEx. And this is, we're fortunate. We have Mike Boschko, who's our VP of Construction and CapEx, does a tremendous job. He's been with us about 7 years now. So he's managing all upfront capital projects and our new developments as well. So between our upfront CapEx and our development spend, we're about $13.5 million of investment that was made into our assets. The existing asset side, a lot of that was winding down the upfront first 6-month CapEx plan over at Palms at Edgewater, the reposition of all the amenities. That was our property in Somerville. We upgraded the clubhouse, the co-working space. We built out a sick outdoor deck over the pond, new grills, fire pits, complete upfit of the FF&E around the pool. And then also Towns at Pryor, which was acquired in October. We've already kind of implemented our phase 1 CapEx plan. We're inside of 6 months of takeover. That was the majority. We did some, deferred maintenance or preventative maintenance at Belmont Heights, resealing and striping the parking lot, and then a continued programmatic interior renovation program at Views at Riverbend in Beaufort. So how does all this translate in the form of, distributions? This is something new that we added last quarter, I believe, sharing the distributions that we're doing to our investor base quarter over quarter. And I think, this is the tell here that, our efforts are paying dividends, no pun intended. But on the 7 assets, you could see here our Q4 distributions from cash flow to investors were just over $2.2 million. We also executed a refinance on farmhouse apartments, as referenced earlier. We returned $9.6 million of capital on that. And the blended Q4 percentage return on equity was 2.13% across the 7 stabilized assets. That does not take into account the return of capital. So it's just cash flow from operations that was distributed. So if you annualize that out and you invested in every one of our assets, you're looking at about an 8% return on the portfolio on an annualized basis. The recently acquired assets, 6 of those properties, we did $840,000 distribution on that. That's about 1.5% for the quarter. So total distributions were just over $3 million in the fourth quarter of cash flow from operations, return of capital from refinance proceeds, $9.6 million. So in essence, in the fourth quarter, we returned $12.6 million of capital back to our investors. Blended return on the cash flow distributions, 1.92%. And that's on $158 million of equity, at the close of the fourth quarter. So this is what it looks like. I mean, I'm obviously personally invested in every one of our assets. If you were an individual investor and you were invested across, all 7 stabilized properties, your blended return, again, would be that 2.1%. If you invested in every deal that we have, the 13 deals, you'd be at 1.92%, so just shy of the 8% annualized return. And again, that's why when we have these conversations with investors, especially the newer investors that are getting to know us, and they ask the question on, well, how much should I do on this one? What should I invest into this one? And I always say the same thing, whether it's one of our ultra high net worth investors or friends and family or, one of our high net worth investors. I always say to them, hey, if you like us and you like the space, figure out your allocation to multifamily. And I'd rather have you break that down across the next 8 deals that we do versus picking and choosing, I'm going to go heavy in this one. I'm not going to do the next 3. Now, again, the beauty of our deal by deal capital raising structure is that our investors do have that optionality. But what we've seen time over time, our greatest investors, not just self-servingly, but for them and their benefit and their cash flow and capital appreciation goals, are those investors that tend to invest in every deal that we do, right? Because some of the deals that we acquire are going to have no cash flow for the first 12 to 24 months because they're very heavy repositions, and we need to execute an operational improvement plan, a capital improvement plan to get the property stabilized. Others, we're going to be acquiring assets that are just mismanaged, or there's an upside down capital stack. The property might be 93, 94% occupied at closing and producing cash flow, but there was capital pressures or capital stack pressures from the seller forcing them to sell. And that may be producing cash flow day one. And then we have assets that we might decide to, monetize inside of the first 3 to 5 years because we executed our business plan ahead of schedule. We achieved a higher NOI in the first 3 to 5 years than we underwrote, and we can strip our returns forward. Then we have other assets that we might want to own and operate for 7 to 10 years plus because they're great assets, great locations, producing steady cash flow. So again, we highly encourage our investors and those of you that are considering investing with us to figure out your allocation that you want to the space, the exposure you want to the space, and then come up with a game plan, work with myself, Rebecca, or Chris, and let's come up with a plan to say, hey, you know what? I'd rather see you. This is what our pipeline looks like. We're looking to do 3 to 4 deals a year consistently. So let's plan that out to where you can invest programmatically with us over the next, 1 to 3 years. All right, so this quarter's property spotlight is one that we hold near and dear to our hearts, Latitude at South Portland. So a lot of things to be super proud of on this one for us as a company. This was our very first ground-up development. It was our first Opportunity Zone project. It was our first project in Portland, Maine. 256 units, 4 6-story mid-rise buildings. We were introduced to an amazing landowner and real estate investor in the Portland market through one of our existing investors that had the land entitled, but was not really a multifamily investor, more retail land development. And we were able to build a great relationship, build trust, where we came in and acquired the land. He ultimately invested with us in the Opportunity Zone fund that we put together to develop this. And we're able to really, this was an extremely pivotal deal for us, obviously. Tremendous appreciation to our investor base that gave us the opportunity to make that transition into ground up development with this. And I take a lot of pride into learning the Opportunity Zone space very early. We have great tax attorney. I'll give a shout out to Matt Rappaport, was highly involved in the Opportunity Zone regulations when it was first announced, and we put him on retainer immediately to really learn and be aware of all the amazing benefits. And to me, it's one of the single greatest programs that's ever come about when it comes to real estate. So a little bit about the deal. 256 units, South Portland, Maine, 4 6-story buildings again. Each building has its own little amenity set. So we kind of developed it with the mindset that we wanted each building to have their own kind of little fitness center, lounge, co-work space because of the climate up there. Just in the winter months, you don't have to leave your building. You have the lobby each building has their own central mail and package system. So really, you can wake up on a Saturday morning, go downstairs, have a cup of coffee, get your mail, get your packages, go upstairs, get changed, go back downstairs, go work out, and then start your day without ever having to kind of leave to go to the gym or go to the coffee shop, etc. The property, we started in 2019. Another big milestone. We had to build this through COVID. We managed all the challenges of supply chain issues. Mike Boschko and the team at PM Construction that built it for us up there. I mean, Mike and I were driving up to Portland throughout COVID when there was no flights. There was times when we were the only people in the airport when we could get a flight. I want to say the first building was delivered towards the tail end of 2020. And it was super well received. I think we might have been 100% pre-leased almost at opening. I think each building has, I want to say 65-ish apartments. And the property, upon completion, since then in 2022, we've been over 95% occupied. It's been a fantastic asset for us. The opportunity here, besides the Opportunity Zone, that we saw in going into a new market and doing a tremendous amount of research and taking our time and our diligence, the opportunity that we saw was that the market was very undersupplied. It hadn't seen new product in nearly 20 years. It's extremely challenging. You need a local expert to navigate. I think it took our partner, several years to get this piece of land entitled for this and rezoned. But it was a very, very undersupplied market that was running at 97, 98% occupancy. And our thesis was that even if the market didn't grow by one single person, if we could just capture 1% of the market, we would be full at our building and the market would still be running at 96%. And then we saw COVID come and Portland, Maine kind of became a hotbed for relocation and remote workers and people returning back home from other parts of the country, coming out of Boston, heading up there, coming out of DC, relocating up there. Just for the lifestyle, it's a tremendous New England city. It's a coastal city up in New England. You got great beaches. You got Portland, downtown Portland, right on the water. Tremendous restaurant scene. Tremendous outdoor lifestyle. A lot of hiking. A lot of outdoor activity. And it was a huge benefactor. And it really kind of put Portland back on the map, where it still hits a lot of top 10 lists for best places to live, best lifestyle, restaurant scenes, etc. So since we've built this, we have seen a pretty significant amount of growth up in the Portland market. And you could see, the occupancy side here and the NOI growth has been really tremendous on this property. So as you could see here, 2021 NOI was kind of hovering around 189 as we were in lease up. We began to stabilize in 22, 4.186. And then you take it fast forward to today, we're at $5.2 million plus of NOI. We started out with rents at $1,823. Our average rents today are $2,400. Tremendous asset, total NOI growth of 25% since reaching stabilization. And, we couldn't be happier with this one. We're super proud of it, what the team's done. Again, we bought it in 2019. The 10-year opportunity zone timeline is 2029. But I think the other really exciting thing about this property is that we were able to get it refinanced before the meaningful rate run up. So as you can see here, I broke down the capital stack here. We went into it with a 65% loan to cost. So we brought 35% of the equity, which is a little over $20 million. I think that's one important thing to note here as well. We will not go above 65% on any of our developments. We don't take preferred equity. We don't do mezzanine lending. We're ultra conservative. We're willing to sacrifice return on paper for safety and longevity and conservativeness to be able to manage through any unforeseens. So our total cost on the project was $58,460,000. And in May of 2022, we were able to execute a refinance at $55 million, just about $55.2 million. And that's with 10 years full-term interest-only loan at 4.92%. So we're able to return about $16.6 million of equity and still have very healthy reserves for the remainder of the hold period. And in addition to the capital we returned on refinance, we've delivered about $7.5 million of cash flow distributions. So in essence, our investors have gotten well more than 100% of their investment back on this deal. And we still have another, 3.5 years of property distributions and cash flow distributions before we contemplate either a sale or another refinance at that time. So super proud of it. Kudos to our team. I have to give a shout out to Deirdre. She's been our manager from day one since 2019. And she has done a fantastic job. We were fortunate enough to be able to get her to move back to Portland from Atlanta. She had roots up in Portland, but she had been living in the Southeast for the last probably 10 years or so. So it was, just a great opportunity for us and for Deirdre. And we couldn't be more proud of what she's accomplished up there. She's built a great community, knows every resident, and really it implements what we want to do on a daily basis for our residents, for our communities, and ultimately for our investors. So a couple of pictures of the property. As you can see here, you can also check it out online. Highly encourage you to. Latitude at South Portland. Just Google that. It'll come up on apartments.com or our website. So I want to thank you for taking the time. That was our fourth quarter 2025 update. I think we're getting a little more efficient as we do this every quarter. Really appreciate you taking the time. If you have any questions, please don't hesitate to reach out to us. Again, you can either visit us at urscapitalpartners.com, reach out to Rebecca at urscapitalpartners.com. Happy to set up some time to speak with you if you have questions about the report or you're interested in investing with URS Capital Partners at some point in the future. Thank you.